Part of our consultation on our IIO report. Today we have some great speakers to present to you today. We've got Melanie Kerner, who's the General Manager of System Planning and Renewable Energy Zones. We have Shira Samocha, who is our Modelling Manager from System Planning and Renewable Energy Zones. And we have Andrew Hardman joining us, who's the Senior Manager in Financial Markets. We've also got the rest of our team here from System Planning and Renewable Energy Zones, also known as SPRES, SP and RES, I should say, sorry, to answer any special questions. And we also have guests from other roadmap entities. So if there are any questions we're unable to answer, we'll probably be able to defer to them. We do want to hear from you today. We have kept this group intentionally small to be able to do so. Please feel free to put any questions throughout the presentation in the chat box. If possible and appropriate, the presenters will answer them as they go. You are also welcome to take yourself off mute, pop up your hand, and ask a question throughout the presentation. If you're unable to or not wanting to, any questions put in the chat box will be responded to in writing after the event and again put onto our website for your future reference. On that note, I will now pass to Melanie, who will kick us off. Melanie.
Thank you, Elizabeth, and welcome everybody. Just to kick off, an introduction to AMO Services. So AMO Services, our purpose is to provide expertise to transform the energy sector. And we're here today in our capacity as the New South Wales Consumer Trustee. And that is our foundational role that we've been asked to perform by the New South Wales Government under their policy, the New South Wales Electricity Infrastructure Roadmap. And specifically today, we're talking about, we're undertaking a deep dive on our infrastructure investment objectives report, which of course is the report that we use to set out our plan to deliver on tenders for the long-term energy service agreements in New South Wales. So we published our IIO report now seems like a long time ago, on May the 16th. And since then, we've run a series of webinars and then a couple of deep dives. The deep dive we ran on the 8th of June about renewable energy lulls or droughts. And then today we're running a session on consumer costs, and that was specifically requested by a number of stakeholders coming out of the webinars to better understand how AMO Services models consumer costs. And then later in the week, we're also running a deep dive session on scenarios and sensitivities. All of this work is to inform our final 2023 IIO report. And so modelling for that will commence in around August. So we're really looking to undertake this consultation to inform the modelling that we do for that final 2023 IIO report. Our objectives today, in response to feedback, we want to outline the methodology we use to calculate consumer costs and to show how we apply consumer costs within the IIO report. And Shira will talk through the methodology, and Andrew from our financial markets team will also talk to how the methodology we use in the IIO report differs from the methodology that's used in other parts of the roadmap, specifically around the contribution determination. Okay. So why do we calculate consumer costs? Well, firstly, it's in our name. We are the Consumer Trustee for the New South Wales Roadmap, and so we have an obligation to act in the long-term financial interests of New South Wales electricity customers. And so to do that, we need to understand the impacts of our decisions on the cost to New South Wales customers. And so it's important that we have a view on what those costs are. Specifically for the Infrastructure Investment Objectives Report, when we create the 20-year development pathway and the 10-year plan, we want to show how that pathway actually does minimise electricity costs for New South Wales customers. We also want to communicate publicly and transparency how the decisions we make will impact New South Wales customers. So how in this case, how the development pathway that we've selected has minimised costs for New South Wales consumers. So we don't in our IIO report directly report on the cost and benefits of the roadmap policy itself. That is the role of the New South Wales government through the Office of Energy and Climate Change. But we do work with them very closely to provide them with data and information to evaluate the impact of the roadmap on consumers. And we've got Ben Cyrilis here today from the Office of Energy and Climate Change. So if there's questions on how the modelling that team has done, how that demonstrates the benefits of the overall roadmap, then Ben's here to assist on that. So even though we think we need to do this anyway, there is a legislative requirement for us to report on consumer costs within the IIO report, and that's set out in the regulations. So we must, in our IIO reports, include a forecast of wholesale electricity costs, and also the cost for consumers under the contributions that are required to be paid by distribution network service providers. And so those contributions we call scheme costs in the IIO report, and they relate to all of the costs associated with the roadmap recovered through the scheme financial vehicle for LTESA's payments for network operators for the transmission projects enabled through our Act, as well as the administrative costs for the entities under the roadmap to operate. So these are the costs that we presented in our draft 2023 IIO report that was set out under 3 categories: the wholesale electricity costs and scheme costs in terms of LTESA liabilities and transmission projects. And that equated to 78 billion over the 20-year horizon. Importantly, they're not new costs, that these costs, wholesale electricity costs, are incurred by consumers regardless of whether there's a roadmap or not, and the work done by the Office of Energy and Climate Change on the modelling without the roadmap shows that the wholesale electricity costs would have been more than all these costs here combined in the absence of the roadmap. And throughout this presentation, Shira is going to set out how to interpret these costs and also the methodology that we use to derive the costs. So I'll hand over to Shira now to start walking through the costs. Thanks, Shira.
Thanks, Melanie. So what I'll talk through now is how we calculate consumer costs first, and in particular talking through the 3 components of cost that we present in the report, and also how to interpret it. So if we move on to the next slide. So around the application of the legislation. So as per what Melanie was talking about earlier, there is legislation that requires us to report on consumer costs, and we interpret that legislation in our calculation of consumer costs in a way that covers wholesale electricity costs to New South Wales customers, as well as costs under the roadmap in relation to LTESA payments and roadmap transmission project costs as well. And in doing so, and I'll talk through in detail through each of these 3 components, in doing so we use principles to develop these costs, and those principles that we use in our methodology are to, of course, meet the legislative requirements. So the costs that Melanie outlined previously around what was presented in the draft 2023 IIO report include wholesale electricity costs, for example, which is not additional to the costs of the roadmap. It is sort of a cost that consumers would be paying anyhow, but it is impacted by the roadmap. And so this is I guess, one of the components that I'll talk through. We also want the methodology to be practical, and so that we can actually calculate it. It needs to be implementable, and it needs to focus on long-term accuracy rather than short-term precision. And we'll talk a bit more in detail about that later on in the presentation. Given the amount of uncertainties that go into modelling and the amount of uncertainties of some of the assumptions that we have to make, it is really important for us to look at the long term and avoid the precision over accuracy fallacy. And we also, of course, want it to be relevant and informative. And part of this deep dive is to get feedback from our stakeholders or yourselves on whether we can present it in a way that's more relevant and informative to yourselves. So jumping into the wholesale electricity cost component, one of the 3 that I mentioned earlier. This chart is a little bit complex, but there's really 3 main elements to it. And the three main elements to it are, first of all, the long term. So that's around that answers the question of what infrastructure should we be building. It's a long-term forecast that identifies the types of technologies that need to be invested in order to minimize consumer costs. The second part is around once we've got that capacity mix, how do we operate that capacity mix? So it's around how does the infrastructure operate? What are the wholesale market outcomes of dispatching that mix? And of course, what comes out of that is wholesale price and New South Wales consumer costs. And the answer, the question that part of the modelling methodology answers is what are the likely cost implications of this infrastructure? There is a feedback loop between the calculation of consumer costs and the capacity expansion itself, given that it is aiming to be it is a plan that aims to be minimizing consumer costs. So obviously tracking that variable is really important to understand what the cost is in order to minimize it. The other thing I'll point out is that all of this modeling relies on a range of different input assumptions. And like all modeling, it's imperfect and relies on a lot of assumptions that are uncertain inherently. And so we do use at the time of modeling the latest market inputs that we have at the time. We've also got, and we align with AEMO as a principle where possible, where relevant, or if we've got access to better information or more recent information, then we use that. But I guess we also rely on some assumptions that are specific to our needs, as well, such as, for example, weighted average cost of capital for different generation technologies, as well as the network options that we consider in New South Wales. And those network options come from our roadmap partners, Energy Corporation, who are the infrastructure planners under the Act. So what this, maybe just to talk to wholesale electricity costs, this diagram sort of talks to the framework overall of our modelling. But a key output of step 2 is wholesale prices, and wholesale electricity costs, as we report on them in the report, are essentially a multiplication of what the half-hourly wholesale prices that the model produces are with demand, with New South Wales demand. And so that leads to the wholesale cost component. And as you would have seen in Melanie's earlier chart, that is the largest component of cost we report on, and it's a cost that is not additional. The scheme LTESA cost is the second component that I mentioned earlier. So the scheme LTESA cost relates to the cost of long-term energy service agreements, which AEMO Services runs competitive tenders for, in order to support sort of investment in infrastructure, which is generation, long duration storage and firming. What we've done here, and I'll talk through an sort of illustrative example. What we've done here is that because this is a long-term 20-year horizon forecast, it is a simplified approach, and it's not a bottom-up cash flow forecast of every LTESA that we expect to sign in the future. It is high level because of the uncertainties of us making assumptions over 20 years around cash flow forecasts of LTESA costs. And so in principle, it adopts what we're calling a missing money approach. And that relates to, for those projects that we're forecasting as being required to minimize consumer costs in the long term, what are their costs and what are their revenues? And those revenues include, for example, the wholesale revenue that isn't a direct output of the second step of market modelling that I outlined earlier, as well as other additional revenue streams that are available to them. So we do make assumptions around additional revenue streams for generation and long duration storage and firming infrastructure, which we outline in more detail in the report. And then we look at the missing amount. So do the projects across their lifetime in present value terms require an additional amount to make whole on their costs? And if so, what is that amount? And that sort of becomes a proxy for the LTESA payment for that project. And we do that across all the projects in our forecast and report on that across the 20 years of the horizon. So maybe just as an illustrative example in the next slide. Thank you. So what we've got here is an example 100 megawatt pumped hydro project. That example project has sort of costs across its lifetime, and that's presented in the line, the dark colored line. It's also got revenues that it achieves through the wholesale market, a direct output of the second step of our modelling process. And we also make additional assumptions about, sorry, still the same slide. Yeah, thank you. We also make additional assumptions around other revenues that it can achieve. These are high-level assumptions, and again, quite uncertain, given that some of these technologies, they've got long lifetimes, and sort of we forecast 20 years away, which is already uncertain, but some of these projects will outlive the horizon of the modelling as well. And so we make simplified assumptions around these revenues. What we look at is across its lifetime, whether those projects require additional payments in present terms, across its lifetime, does it require additional payments to make whole? And if so, those become the differences on an annual basis, and that's what's shown in the grey bar there as scheme revenues. And so this is from the perspective of the generator, I should say. And so from the perspective of the generator, it achieves wholesale market revenues, it achieves additional market revenues. It also requires scheme revenues in the form of a proxy for LTESA payments, and we do that for all the projects that are eligible that we model across the 20 years. And that leads us to an annual sort of estimation of LTESA costs across all of those projects that we then present value back in the way that we report on costs, which I'll talk through in a bit more detail shortly. So finally, there's the third component, which is the transmission costs. And so the transmission costs specifically refer to transmission projects under the roadmap. And so those are renewable energy zone network infrastructure, for which we've got a few different transmission options that are forecast in the draft 2023 IIO report as optimal, and those across Central West Orana, New England, and the Hunter Central Coast reses, as well as the priority transmission infrastructure projects, which we've assumed to be Waratah Super Battery and the Hunter Transmission Project. Those are the projects that are included in the transmission scheme cost component of our consumer cost results. And in particular, something to point out is that the way that we report on costs for these transmission projects relate to annualized costs, which make an assumption around their lifetime of 50 years, as well as a rate of return assumption, which in this draft report we have assumed to be in line with the AR determination for Transgrid. However, we only look at the 20 years of annualized costs of the modelling horizon, and this is distinct from the capital costs of the project, and distinct from the costs also that were reported in the network infrastructure strategy by our roadmap partners Energy Co recently as well. So that brings us to sort of the high level methodology of those three cost components that we report on. Another item that I will cover now is around interpreting the consumer costs. And so we have those are the components, that's how we calculate it. But we then present sort of two different charts in the report, which I'll talk through now in terms of how they should be interpreted. So there's two charts on the right-hand side, which go to the charts that we've presented in the report. One of them is the annual cost, and that annual cost stack includes those three components that I mentioned and presents them on an annual basis across the 20 years. So as per the legislation, those are the three cost components that we sort of, in the way that we've interpreted the legislation, that we've calculated them and presented them in annual cost. And so these costs are presented in line with the modelling assumptions that we use. They are presented in real terms, and they are presented in 2021 dollar terms, given the assumptions we were using to inform this report aligned with the 2022 ISP, and a lot of the input assumptions were used from the 2022 ISP. The second chart it essentially takes those annual costs and creates a present value of those costs across 20 years. And it does that by using a real discount rate to convert them to a single number, a single value in billion-dollar terms. And that 5.5% real discount rate, again, is aligned with the 2022 ISP assumptions. One thing to note is that, of course, for the final IIO report, we will be using the latest assumptions that will be available at the time. And so we already know that AEMO's got a latest assumption around real discount rates, which is 7%. And so there's a whole range of other assumptions that will be updated in the calculation for the final. But essentially, in terms of the content and the way that we're presenting it, this is how we intended for it to be interpreted. But I guess we are seeking your feedback around whether that is clear and whether there are better ways for us to be presenting our costs. One other thing to note is that all dates are on a financial year ending basis. The other thing I wanted to point out is that we have received some feedback already that of course, we've been presenting in real terms, costs in real terms, but we have received feedback that the presentation of these costs in nominal terms would be informative and relevant for consumers, given those will be the actual dollars that consumers will be paying. And so we are currently within AEMO Services considering whether there are better ways to communicate cost impacts in the future. And in particular, given that a lot of the input assumptions that we do rely on that are publicly available are in real terms, we're considering which of those input assumptions would be likely to be impacted by inflation, and what would it take for us to convert them to be nominal terms as inputs to our modelling. And so we're investigating those avenues at the moment to sort of improve the way that we're reporting and make it more relevant and useful for our stakeholders. I might pass on now to my colleague Andrew to talk through what these costs that we've sort of been talking about as in the draft 2023 IIO report are not, and how they compare to some of the other measures that are available in publicly.
Sure, thanks, Shira. Just move on to the next page. Fantastic. So we'll just have a quick touch base on what are we talking about in respect to a customer bill, and how does the I guess the roadmap actually impact on it. So what we have here is got a typical bill. We've just sourced these information from our friends at Ausgrid. As you can see there, the latest update. The majority of the bill construction is made up of wholesale electricity costs, and that has been modelled in the IIO, and it's also directly impacted by the New South Wales roadmap. And the idea there is, from a roadmap perspective, it's going to be we're looking to decrease that cost component of the bill by bringing renewable generation on board, which tend to bid a lot lower than traditional fossil fuel generators. The second piece is obviously the network infrastructure piece, and again that's modelled in the IIO report, and also has a direct impact via New South Wales roadmap costs, and that's done through I guess scheme costs with through the DNSP's contribution to support such things as CWO, priority transmission infrastructure projects, and other supporting projects for New South Wales electricity infrastructures going forward. What's not impacted and was not taken into account by the IIO report is obviously the environmental policies, such as the LRET or the SRET, and also any I guess retail and demo allowances. So that's the key point there. But what I want to just touch on next is, I guess, going through the construct of how the I guess the roadmap impacts the New South Wales consumer from a cost perspective, and how that actually translates. So just going from 1 to 7 on the first thing here, we have our the IIO report, which is published, providing the 10-year plan. That then leads to tenders, which is run by ASL, and so competitive tenders run every 6 months to procure renewable generation and long duration storage into New South Wales, and those themselves will provide for potential additional costs, which is going to be obviously outweighed by benefits via lower wholesale electricity prices. Those costs are then collected by the scheme financial vehicle, who is the counterparty to these LTESA agreements. Remember, the LTESAs are derivative instruments that provide pricing support for projects to enable them to come into New South Wales earlier than what they would have projected to have done so without them. This information is then fed through to the Australian Energy Regulator via the contribution determination process. They review the information provided, vet it, and then send it to the New South Wales Government for gazetting. That then provides the framework for New South Wales DNSPs to then provide contribution payments back to the scheme financial vehicle to support the roadmap. And those DNSP payments are procured through retailers from the line item in respect to network operator costs. And the retailer obviously then procures that monies from New South Wales electricity customers, which is a portion, I do stress, a portion of their customer bill. So from there, let's just have a quick look at the following slide. And so I'm just going to just quickly deal with the contribution determination as opposed to what the IIO report consumer costs looks at. And there are two very different things here. From a contribution determination perspective, what we're looking at is, I guess, LTESA costs. And when I'm talking about LTESA costs, it's the potential costs under the pricing support mechanism that are provided to both renewable generation and long duration storage projects. It also looks at the new, I guess, network infrastructure that's required to be built to provide these modern power plants of today and the future. We look at the time frame is very much on a rolling 3-year basis. So it's very different to the IIO report, which looks at a 20-year time horizon. For consumer contribution determination, we're just looking at a rolling 3-year average, which is providing support for the that goes through the AER. And also the cost difference here is quite significant. As you can see there was a gazettal for a procurement of $138 million to provide for scheme costs, which, as we mentioned before, looks at, I guess, LTESA costs, potential network infrastructure costs, and scheme administration costs to support the roadmap going forward. So it's a very small part of the overall bill when we put into contextualization against the actual wholesale electricity price or the cost that's paid by New South Wales consumers. And the responsibilities, again, very different. The AER is responsible for the contribution determination, whereas the consumer cost report is the responsibility of AMO services. And finally, the contribution determination is an annual determination event, whereby the IIO report is a 2-year event. I may just pass over to you, Sherry. Do you want to make any other observations in respect to this table?
We have added that sort of sentence down the bottom to put, I guess, to add another perspective in terms of how the contribution determination might compare to other revenue allowances, recent revenue allowances for some of the DNSPs in New South Wales. That's, I guess, just a comment to put some of these numbers in perspective. But I guess that the main takeaway here is that the cost that we're reporting on in the IIO report, including in the 2023 draft that we've sort of been talking through today, are fundamentally really different from the contribution determinations and much higher level and simpler and have a different purpose and objective than the AER contribution determination.
Excellent.
Thank you, everyone. So as I mentioned, we do have some key areas that we are looking for consultation on. Shira, Melanie, did you want to talk to these points here that you're looking for feedback on?
Yeah, happy to do that. So hopefully today the presentation has given you more insight into how we calculate consumer costs. But we would like feedback either today or through your submissions on how we can more clearly communicate that, or whether the information we provided in the IIO was clear. We're also looking to understand, is there more information or other metrics that that might be useful for you to better understand consumer costs? And have we clearly set out how the costs in the IIO should be compared to the costs that you see in the contribution determination, and what more information might you need to better understand that?
Thank you so much. We do have a few questions in the chat box, so I'll pass them across. But just a reminder to everybody to please type your questions in there. We are looking for your thoughts and feedback. This is the purpose of today's event. Please also feel free to put your hands up if you want to take yourself off mute and have a conversation. And just a reminder that any questions that don't get answered during today's session will get responded to in writing. I will also let everybody know that the consultation period closes on the 30th of June. The formal feedback needs to be sent to the web address, the email address, iioReport@aimoservices.com.au, and I will shortly put a link to that email address in the chat box. Melanie, I might throw our first question to you. Why is it apparently easier to estimate scheme costs over 20 years than admin costs beyond a couple of years in the draft IIO?
It's definitely not easier to estimate scheme costs over 20 years compared to the administrative costs. So I think we've picked up on that feedback and do intend to include admin costs and use the data points that we have in the contribution determinations now to provide a forecast of admin costs in our final IIO, but it is certainly not easy to estimate the scheme costs over 20 years. I'm using the market modelling approach that Shira has set out. In fact, it's required a lot of innovation from AIMO and AIMO services to take the existing ISP approach and modify that in order to optimise for consumer costs rather than lease system costs. So yes, forecasting admin costs should be a much easier exercise compared to that, and we fully intend to do that in the final IIO report.
Thanks, Melanie. Shira, at what level of granularity are wholesale prices modelled? 5 minutes, hourly, daily?
Yeah, so on this question, of course, currently the way that the market actually works is prices are set every 5 minutes. It is important to capture the intraday sort of changes and dynamic nature of prices throughout the day. 5-minute granularity is quite difficult to model in terms of the computational complexity of having that amount of data. And so we do use half-hourly based inputs that lead to half-hourly based outputs from our second step of market modelling, including the outputs on wholesale prices. And that allows us to capture in sufficient detail in a practical way such that we can actually do it in terms of the amount of data, the intraday volatility of prices, the impacts of rooftop solar throughout the day, and the impacts of different technologies' ability to reduce prices as well. So half-hourly is the short answer.
Thank you. The next question is, why is the discount rate used for transmission scheme costs not consistent with the ISP methodology?
Yes, I'm happy to start with that one. It's a good question. The ISP does use a single assumption across the discount for discount rate and across the WACC of different technologies in line with the AER CBA guidelines recommendation. We in the IIO report are not bound by the AER CBA guidelines. We do have a principle to align with AIMO's assumptions where possible and where relevant. But this is an example, our sort of weighted average cost of capital assumptions where we actually divert from the ISP on. And we do use the same discount rate. We have used the same discount rate as the 2022 ISP for sort of present valuing costs back into present terms. But the weighted average cost of capital assumptions, we do make specific assumptions on per technology. And the reason that we've done that is really to reflect the different financing and construction risks that we know exist between different technologies. For example, the difference between investing in solar and investing in pumped hydro is going to require some pretty different risk profiles, both in construction sense and revenue profiles over time. And so we, reflecting that difference in sort of risks between different technologies was deemed as an important consideration within our IIO report, given that the application of our report being quite commercial, and so to inform, I guess, how we're going to tender for these projects and how we're going to sort of plan over the next 20 years in a way that minimises cost to New South Wales customers. So this is an example where we did divert from the ISP for that sort of commercial purpose.
Elizabeth, can I have a follow-up question, please?
Sure.
Thanks, Shira. I think there's confusion here between what you answered and what I asked. I'm talking about you're diverting from the ISP assumption. Even if you say you're going to use different discount rates for different technologies, and that's a separate debate that we're about to have with IIO, with its review that's underway now. I should explain to the other people that it's Mark Renning here from the Energy Users Association. I'm also a member of the ISP Consumer Panel. My comment is that if you follow the view that says you have to have consistency between the same technology or the same investment, then you would have a central case assumption for the transmission scheme costs, not the most recent Transgrid AER determination. Because what the ISP does is get a central discount rate following the CBA guideline for transmission costs, and that's not the AER most recent WACC, it's the central case. The AER's most recent WACC is a lower bound that the ISP does under the CBA guideline. So I'm not talking about different discount rates for different technologies. I'm talking about what's the appropriate methodology for using in the transmission scheme costs, and that's not the lower bound, which is set by the AER at Transgrid.
Yeah. No, it's just to make sure I'm understanding your question now, and apologies for misinterpreting, Mark, is what you're asking, why did we sort of choose that particular assumption for transmission WACCs being sort of the closer to the lower bound, which was 4% as per the 2022 ISP, which we based on the AER Transgrid determination? Is that your question?
Yes.
Yeah, and so it is. So at the time, this was what we thought was the most reflective of the costs of transmission projects. It is something that we are sort of thinking about for the final IIO report and welcome your feedback on. We are broadly, maybe just as a broad comment around our weighted average cost of capital assumptions, updating them for all technologies, including the assumptions that we will make for transmission for the purposes of the final 2023 IIO report to be published in December. And so we're sort of undergoing that that project at the moment with the help of consultants, and we fully intend to use that for the final report and also publish that when that information becomes available. But we welcome your feedback in the meantime, Mark.
So I'm just trying to understand as I draft my feedback is that the generally accepted view in investment circles, from my experience, is that an investment decision on a transmission network is not based on a forecast of the 5-year WACC, it's based on a long-term, given the asset life of 40 or 50 years. So I'm wondering why you think a 5-year WACC in a Transgrid reset is indicative of what an investor would require over a 50-year asset life, because that's effectively what you're saying.
I think that was effectively our assumption in the draft 2023 IIO report, that the 5-year WACC was appropriate to consider for the lifetime of the transmission investment. And so we would be keen to understand alternative views, and we're running a consulting project at the moment to update that number to reflect the most appropriate lifetime WACC for transmission.
So is that a separate consultancy project than the one that IIO is currently running for the ISP?
Yeah,
so yes, you've got two consultancies out asking the same questions of the same investors.
They're slightly different purposes. So I guess the project that sort of I was referring to earlier is really intended to understand and we are, I should say, collaborating really strongly with IIO. So we're aware of their project, they're aware of our project, and we're working closely together, but the objectives are a little bit different, and the way they'll be used in modelling are a little bit different. This is a key area where we do actually divert between the ISP and the IIO.
So, sorry, just one last question. How do consumers get confidence there's going to be consistency between the roadmap and the ISP, given under the rules, the ISP has to accept the roadmap as effectively a given in the standard assumptions methodology, when it seems that the output for the roadmap, which is an input to the ISP, is based on different assumptions?
Yeah, I think I can take that one. So, I mean, AMO services, we make we are an independent subsidiary of AMO, although we do work closely with them, and so we make the assumptions that we think would give rise to the best outcomes for New South Wales consumers, and then that becomes part of New South Wales government policy and is adopted for the purposes of the ISP, and there are constraints that AMO has in terms of the AER CBA guidelines, but we do share information, and we are aligning where we can.
Very good, thank you. Thanks so much for your feedback, Mark. We'll jump to another question now. We've got one here. The slide with the LTESA cost for 100 megawatt hydro project, why the scheme revenue is negative in 2034 and 2036. Andrew, are you able to talk to that?
Yeah, sure. Just very high level. With the LTESA agreements, it's actually a legislated requirement that the that either generation or LDS has a mechanism in which they can be able to, I guess, recoup funds from the LTESA operators if there's been a benefit to them in the past. In this case here with LDS, there is a repayment mechanism, and we're forecasting in 2034 and 2036 that there'll be, in this case here, probably some higher price volatility, which will provide revenue potential for those operators, which will then be reimbursed back to the New South Wales customer. So high volatility prices, LDS operators receive a benefit from that. That benefit partially is passed back to the New South Wales electricity customer, which will ultimately help, I guess, benefit their customer bill going forward.
Thank you. And we have another question here about the LTESA. In terms of firming project, they may reduce the wholesale cost, but this seems that it would consider its LTESA cost. This would give preference to embedded storage to a generation project. Is this what is favoured?
I can start with this one,
sure.
and yeah, feel free to jump in, colleagues. In the way that so assumptions around embedded and aggregated sort of behind the meter storage are input assumptions that we don't explicitly record the costs for in the cost forecast that we have. We sort of align with AMO's central assumptions or base view assumptions, and in this particular case it was the step change scenario assumptions from the 2022 ISP around what the uptake of those are, and it's sort of assumed as a sunk cost, if you like, for those technologies. For firming projects, in terms of the costs that eventuate from the firming infrastructure in our forecast, they relate to sort of utility scale additional capacity in addition to the assumptions we make in embedded storage. The costs, one thing to note is that there is a sort of negative correlation between the wholesale cost component and the scheme cost component, where we have additional scheme costs to sort of facilitate the construction of additional roadmap infrastructure. That tends to have a reducing impact or a depressing impact on the wholesale cost component by reducing wholesale prices. So there is that negative correlation, which you'd be able to see looking at the annual sort of profile of those costs. And so with the firming costs, the way that because as one of the things I mentioned earlier is that we try and minimize consumer costs when we're planning for infrastructure, that has to consider both the reducing impact of this additional firming infrastructure on the wholesale market, on the wholesale price, and therefore the wholesale cost to consumers, as well as the additional cost that arises from the construction of that infrastructure and the costs that are required to enable that project to break even through the proxy for the LTESA costs. And so both of those costs are considered and weighed against each other to make sure that costs are minimized overall. One thing in particular, though, about firming infrastructure is we don't have a minimum objective for firming infrastructure, and we sort of tender for firming infrastructure based on ministerial direction. And so what we published in the 2022 IIO report, which is a previous report, was in response to a ministerial direction of a gap in the energy security target, which led to sort of a firming size identified to meet that energy security target, and that sort of is assumed in the model, and the costs of that are reported on. Hopefully that's helped clarify some things, but jump in here, team, if anyone's got anything to add.
Thank you. So there's a follow-up question from the same person. How is the cost to cover unmet energy by VRE generation variation considered in the cost?
And so feel free, Taichi, to correct me if I'm misunderstanding your question, but assuming that what you're referring to by unmet energies as spilled energy, the way that that's dealt with in the model is we do have outcomes around curtailment of variable renewables, and curtailment that's based on, for example, economic curtailment, where prices are really low and there's a high amount of availability of wind and solar at the time, then some of that might be economically curtailed. The way that that's sort of indirectly affects costs is that in a couple of ways. So in terms of the infrastructure required, so if we sort of build so much electricity infrastructure that the costs are quite frequently depressed, and economic curtailment often occurs, then that would lead to an increase of costs from an LTESA perspective, whereas having not enough electricity infrastructure, not enough VRE infrastructure in particular, might lead to wholesale prices being quite high and the LTESA cost therefore being low, and the requirement for additional revenues being low. And so curtailment and sort of spilled energy, if you like, is considered implicitly in the way that we optimize for how much capacity is required in order to minimize costs to New South Wales consumers and meet the reliability standard. And so it's rather than being quantified on its own, it's quantified implicitly through the optimization process of ensuring that maybe some curtailment is actually in consumers' interest, because building additional capacity it actually depresses wholesale prices, and that has benefits for all. And so it is considered implicitly in that way.
Thank you, Shira. We have a question here which is more directed at our colleagues at OECC. So Siobhan, are you on the call and able to respond to the question to talk more about wholesale prices with and without the roadmap?
Yes, I'm on the call, and I'm really happy to answer this. So what happens without the roadmap? What happens down the line in 2035 beyond, after that, when all the coals have been closure? So there'll be a gap from the generation portfolio. So what if there is no transmission projects or like the energy roadmap? If we don't build much more capacity to take those generation from the REZ, there'll be shortfall from the energy in the portfolio. And what's going to happen when there's a shortfall? There'll be high price volatility, and there'll be high price, and that would lead to a high consumer cost. So to incubate, to support the REZ zones, we must need to build the new infrastructure from the generation perspective, so that we can have more renewables into the portfolio.
Thanks, Siobhan. Hi, Tariq. Thanks for the question. I'll expand on that a little bit. So the purpose of that the no roadmap modeling exercise was to estimate really what the generation mix and therefore wholesale prices and then retail prices would be in the absence of the roadmap. We made some assumptions in there. They're all detailed in our report, and we are doing a deep dive on this in a couple of weeks. If you do want to kind of go through those assumptions, it is a little bit of crystal ball gazing. We're trying to estimate what the policies would be without something like the roadmap. Generally, the results showed that there is a bit more reliance on coal, a bit more reliance on gas, some more firming infrastructure that needed to be built, and less renewable build. And so all of that contributed to higher wholesale prices. And yeah, that's a main contribution to that, the draft estimate of the 10.6 billion NPV saving that we had. So we are still working on refining that model along in conjunction with the final IIOs, and with that we'll be able to publish some detailed estimates of what the consumer bill savings are down to that level, rather than just that NPV figure. So does that hopefully answer the question?
Thank you. We've got time for one last question, which Dominic, if you're on the call, Dominic Price from our System Planning and Renewable Energy Zone team, you might be able to answer this for us. How are new policies in other jurisdictions reflected in the IIO, i.e. the recent changes in the VRET and QRET since the 2021 IASR?
Thanks for the question. So in short, this modelling exercise took outputs from the 2020 final 2022 IASR released mid last year. So that does have VRET, QRET, and TRET as well, the Tasmania target. Our next modelling exercise for the final 2023 IIO will take the final 2023 IASR assumption set, which will be released soon by AMO. So that'll include the updates to those policy targets.
Excellent. Thank you so much. I'd like to invite everybody to please continue to put all your questions into the meeting chat. We are going to close this meeting off now, as we only have a few minutes left. Have just put the email address that you can send any feedback or submissions to before the end of June for feedback. They will all be considered and responded to. Please do not hesitate to reach out if you would also like to have a meeting to discuss any of these items further. So if you, thanks, Ben. Ben has also put the modelling report into the chat for your reference. If anyone has any further questions, please do reach out. The address is there, and we will wrap this meeting up now. A big thank you to all of our presenters today, and thank you all so much for your time in attending today.
Thank you.
Thanks, everyone.
Thank you.
Cheers.
Thanks.
Thanks all.